Hi, today we are speaking to Sebastian Lyon from Troy Asset Management. Troy is an investment boutique that was set up about 15 years ago. They manage around 6 billion of assets. They're based in London. Sebastian Lyon is the CEO and an investment director at Troy. Sebastian, thanks very much for joining us. So there's a number of funds and a couple of investment trusts that you run. Today, we wanted to talk about Trojan Fund and personal assets, the two which are very similar in terms of the investment process. Maybe we could just start with what is it? What are you trying to achieve in terms of the investment approach, and what do you think gives you an edge over some of the competitors?
So for Personal Assets Trust and the Trojan Fund, our main aim is capital preservation, long-term capital growth, but very much with the emphasis on protecting the downside. And we have a tendency of performing better in more difficult market conditions than more ebullient market conditions. Where we differ from our competitors is that we have a great deal of patience. We're not under very intense pressure to perform over very short periods of time. And in particular, from the point of view of the way that we go about investing, particularly within the stock market, we can be very selective in terms of the way that we go, the kind of companies that we invest in.
Great. Okay. And in terms of your stock market exposure, so I think the allocation to the stock market got as low as sub 40% a few years back, and prior to that it got as high as maybe 70%, 2009. Maybe you could just talk about what influences that allocation and also where we are today.
Right. Well, the range has been between, when we started the fund, it was around 30-35%. Markets were very high at that point back in 2001. We then shifted the asset allocation very positively in 2002-03 after markets had fallen. And then as we came towards the crisis in 2007, 2008, equity allocation decreased to around 40%. And then we increased it after the crisis, post-Lehman, right up to about 75% as we came out of the crisis in 2009 and into 2010. And then gradually that has decreased as we've gone through the investment cycle. And today it's around just under 40%. So it's around the same levels as it was prior to going into the financial crisis of 2008. So we're about as conservatively positioned as we can be. And also within the equity part of the portfolio, that is actually, in generally speaking, pretty sort of conservatively managed businesses, pretty defensive businesses at the moment. So we're not actually trying to play a sort of stronger economic cycle. We're trying to play a sort of more defensive economic cycle at the moment as well.
Okay. So if markets keep falling as they are today, then you would expect to hold up reasonably well.
We would, yes, absolutely. I mean, so far, since the market peaked in April, the fund has held up pretty well.
Fine. Okay. Now, some investors in the fund, current investors, may feel that the performance has been a bit lackluster in recent years. I just wondered if you talked about what you would say to those particular investors.
Yeah, I mean, the fund essentially did very well up to about the last quarter of 2012. We had 3 or 4 very good years. And I think that as we go through the investment cycle, we will, as I said, from an asset allocation point of view, we will take chips off the table and we will decrease risk as valuations increase. And I think the one mistake that we made was that we decreased risk too early, particularly missing out on the very sharp rally in late 2012 and into 2013 when Mario Draghi said he'd do everything, all that it takes to save the euro. We missed out on that. We had a better year actually in 2014. The fund was up 9%. I think the market was up 1%. And this year, obviously, the market's down and we're sort of flattish. So, it has been a dull time. We would expect during periods within the cycle and the latter part of the cycle, as we move more defensive, but markets become perhaps more ebullient, that is exactly the time when we're likely to underperform. And then as we come into these more difficult times, which perhaps we're in at the moment, since April, then that is when we would expect to get our relative performance to be a little bit better, and then ultimately shift our asset allocation to be much more positive, as and when we find the better valuations. The thing that, to answer your question about what drives the asset allocation, that is purely valuation. So both valuation from a bottom-up stock picking perspective, so where we find good value particularly in the areas that we like investing in, but also we look at the overall market and where valuations are. And just at the moment, prior to the market peak around the market peak in April of this year, valuations were very high. There'd been a huge reach for yield, and equity valuations were higher than they were in the summer of 2007, where markets had peaked before. So that's the reason why we were particularly cautious. As and when we see markets fall and valuations become more compelling, then we will shift our asset allocation to be much more positive.
Fine. Okay. And in terms of the portfolio as a whole, obviously there's a lot of other areas. So apart from equities, you've got some index-linked bonds, you've got gold.
Yeah.
Could I ask
you? We've got a lot of cash at the moment as well.
And a lot of cash as well. Could I ask you to pick out maybe one particular investment that you've got you think looks, particularly appealing in this environment?
Well, I think that to go to our single largest equity holding would be an obvious port of call, which is BAT. British American Tobacco has been in the portfolio going back to 2002, which actually highlights the very low turnover in the fund. When we find a stock and we like it, we tend to stick with it, tend to back it. We get, it means we can get closer to management to some extent and get familiar with them and discover their longer term strategy. And we bought that back in 2002. The yield on our investment, the initial investment that we made, is a remarkable 27%. The dividend yield on the first investment that we made back then. It's grown income very, very robustly. In the last 5 years, dividends grown 7%. It's a sustainable dividend yield of around 4.5%. So it's a company we have a great deal of confidence in over the long term. It's got very good geographical diversification, and they've made some very sensible moves over the past year as well in terms of, from a corporate perspective, buying out their subsidiary in Brazil at a very depressed price, partly due to the very material weakness of the real this last couple of years. And they've also supported their US associate, Reynolds American, in buying Lorillard, the third largest US tobacco manufacturer. So it's a business which we have confidence in the management, confidence in long-term dividend growth, and within this economic environment of very low growth, we think that it's still a sector which we're happy to back, for the longer term.
Okay. Fine. And just to clarify, that 27%, that's the cumulative dividend since on the
that's not the cumulative dividends. That is the yield today on the dividend that they're paying today, compared to the capital that we outlaid back in 2002. So it's not the dividend yield that you get today. The dividend yield that you get today is 4.5%. But what it shows is the very strong dividend growth that you've had in a period where actually the market's done very little.
Yeah, perfect. That makes sense. Final question, just about alignment of interest. Our investors, our clients do like to know the extent to which their fund managers are invested in their own funds. Is that something you're able to share with us?
Well, part of it is a matter of public record, which is my holding in personal assets. My holding in personal assets is by far and away my largest single investment. I hold 9,000 shares at just over £330, so that equates to around £3 million of investment as at today's prices. Right. So a very meaningful commitment.
Okay, that's great. Sebastian, thank you very much for coming in and sharing your thoughts with us.
Thank you.
Hopefully that's been of interest. If you'd like more information on either the Trojan Fund or personal assets, please contact your Killik & Co broker or wealth manager. Thank you.